Welcome back. Dow's up 38 points right now. It's moving, as it always does, up slightly during our 12 o'clock hour. 38 points up, much better than what it was this morning because those durable goods orders and European markets sort of killed our markets when we opened this morning. All right, so we've been talking about QE2. What happens when QE2 ends? What's the Fed going to do? Is inflation going to hit? Are they going to raise interest rates? Who the heck knows? Well, Stan Dash might know. Vice President of Applied Technical Analysis at TradeStation. He's with us here today. Stan, thanks for being here.
Thank you.
Now, the notion that there are futures out on the Fed funds rate could be comical to some, but it's no different, I suppose, than betting at a racetrack.
Well, we prefer not to use the word betting, but there are futures on Fed funds, and the idea is that those who have a risk to interest rate changes have a way to hedge those risks. One of the things we like to do at TradeStation is see what we can learn from a market and about how markets talk to each other by looking at prices and price action. What's
interesting about the market, and you know, I've been doing this, I don't trade, but I've been following it for years now, is that the market really does, it's almost a person in and of itself. You know, everybody talks about the market doesn't like you know, you're talking like a little kid.
Yeah.
But it's very true. And you just have to learn how to listen to the market, don't you?
The market tips its hand, and
yeah.
sometimes we don't get the cues, but if we pay attention and we're patient, sometimes it does tip its hand.
So what is the market saying right now about what the Fed is going to do about the federal funds rate?
Well, as you said, the Fed funds futures, a futures market based on the short-term interest rates set by the Fed. Because of the way the futures contracts are designed, the maturities in those contracts and how they work, they give us a way to calculate the odds, the probabilities of a Fed change in interest rates.
Now, just so people understand, the Fed funds rate is the rate that the Fed charges banks to borrow money from them. Right now, that rate is anywhere, it was what, 0 to 0.25%?
It's 0 to a quarter.
It's basically
right.
Negligible.
Correct.
It's a joke.
Correct.
So, raising it to just about anything is unfortunately still a joke.
Well, it's going to be an important event when they finally do raise it, because interest rates run in cycles.
Agreed.
When we go into tightening cycles, they tend to last. We go into loosening cycles, as we've been in with the recent economic problems, they tend to last.
So your point's a good one. So once they start, basically it's off to the races, is what we're saying.
Yeah.
Okay, so when are we looking at the first rate increase?
The marketplace is telling us that January 12 is the first reasonable probability of a rate increase.
That's post-election?
That's post-election. No, January 12th.
Oh, January 12th.
Yes.
Okay.
Yes, beginning of next year.
Interesting. So end of this year, beginning of next year, January of next year, we start to potentially talk about rate increases.
Now, when you dig into the math, that's only approximately a 56% probability of an increase of 1/8%.
Whoa.
Yeah.
In January.
In January. So those are very small numbers we're talking about, but the important thing there is the beginning. Will it be the beginning of that next cycle?
So it could very well still be nothing in January.
Well, I think that people will react to it, and the markets will react. We don't know what the rest of the environment will be with the economy, with the dollar, but it will be important because once the Fed starts, we know it tends to work into long-term cycles.
Right, and this short-term interest rate translates to all of us at some point. So it's a big picture story. I mean, anybody that gets a loan, gets a mortgage, somehow it'll trickle down. So, but again, you're talking about what did you say, 0.8?
Well, I say an increase of 1/8%. Let's say to take the rate up to 3/8%, and you mentioned 0 to a quarter.
Yeah.
So we're using a 3/8 as a possible target for January.
So still under 0.5. So now we're all right. So it's still low.
Now, what we were looking at is where would that take us as we stretch the curve out further? Now, we know, just like a meteorologist, the longer you stretch your forecast, the more chance there is that it wouldn't work out.
Mm-hmm.
But we're looking at maybe a 1% interest rate by the end of 2012 or the first quarter of 13.
On the Fed funds?
On the Fed funds.
But now that's election time.
Now that's election time.
So what happens there? Do we back up? Do they say don't do anything until we finish these elections? Probably.
Well, there's always controversy between how much the Fed is influenced by politics when it's not supposed to be. That's not my area. I'll leave that to the pundits to discuss that.
I don't know anything there. Is this now, okay, is this 56% chance of an increase in January, excuse me, because of inflation?
Well, I'm looking at it the other way. What we do at TradeStation is we look at the market and let it tell us. We're not looking for the reason why. We're looking for what the event may be. So maybe it'll be due to inflation. Maybe it'll be due to the economy picking up and labor conditions improving. Maybe it'll be due to a need to support the dollar a little bit with some higher interest rates. What the motivations for the chairman and the Federal Open Market Committee will be up to them. We're trying to read the market action, and from the market action, what do all the observers and analysts think? The market is telling us a little over 50% chance of a rate hike first part of 12.
What other statistics can you gather from what the market's telling you these days?
Well, what you try and do is we try and look, of course, just as people look at a VIX to get an idea of people's levels of worry. People look at gold to get an idea of inflation, in addition to trading or investing.
And I should be clear, the VIX is what's the volatility 30 days out. So 30 days from now, how do I feel? And if it's high today, that means 30 days from now, I'm going to be nervous. Right.
We're always looking to take the pulse, take the temperature. And what we do in our group in TradeStation is try and look to help our clients find better ways to see these interrelationships. And I think right now what you see, in fact, today you were mentioning that the stocks are up at least a little bit. But we also have gold was up a little bit before I came in. Silver was up nicely when I checked just before I walked in. So we're seeing a return into assets today. Maybe we're seeing both the return and maybe an inflation concern coming back again with stock prices and metals prices moving higher.
It's hard to read this market these days, isn't it? Like, I feel like everything you learn in school is wrong. Stocks up, dollar down, that doesn't really work anymore, right? You know, stocks up, gold up, that's wrong too. Everything that you've ever learned is gone.
Well, if anecdotal evidence is anything, I just returned from a financial conference in Italy. And in a chance to walk around, I can tell you there were plenty of U.S. dollars being spent by tourists.
Yeah, I bet.
And not just me. being spent by tourists there, and that the dollar didn't seem to be hindering Americans visiting.
Oh, that's interesting.
We were
Even though it was
it's
supposedly up.
Yeah, yeah.
It is still the safe haven, though, isn't it?
People still have a tremendous regard for the U.S., for the U.S. economy, for its ability to move, to gather and move capital, and its ability to generate economic activity around the world.
You are in technical analysis.
Correct.
May I ask, what is one of your favorite statistics? Like, what is one of the things you come to the most to get an idea of what the market's doing? Well,
I think that when people look at the stock market in particular, I think that many people overlook something known as market internals. We tend to look at the stock market and we look at what is the Dow doing, what is the S&P, the Russell, we look at the indexes, and we forget that those indexes are a composite of 30 stocks or 500 stocks or 2,000 stocks. I think if investors look at what are called internals, what's going on inside that number, that one number that represents 500 in the S&P 500?
How do they do that?
Things like advanced declines, which is telling me how many of the 500 are rising or falling, how many of the 500 are making new highs for the year or new lows for the year. Even on an intraday for shorter term traders, how many of the 500 are trading higher intraday or lower intraday. That whole area is known as market internals, and it's very powerful information to understand stocks.
Dash, that's a really good tip, because you can get all that stuff readily on any of the good, any of the good websites will show you the day's advancers, decliners. I mean, that's at Wall Street Journal site, all of them. Any of them that you go to their market sections, and they all show you that stuff. That's a great idea. I love the notion, though, that you guys are tracking the Fed funds. And
I think that's it's going to be a bigger story. Hopefully we'll get to talk about it. And as we said, once the Fed does start to change those rates,
it's off to the races.
It starts a cycle.
So you got to come back, Stan, because it could get interesting. Stan Dash, VP of Applied Technical Analysis at TradeStation. Thank you, sir.
It was a pleasure. Thanks a lot.
That's cool stuff.